Are rising interest rates terrible for the stock market? Now, if you follow the financial media, you would certainly think this is the case. There seems to be a consensus around the media that rising interest rates are downright destructive for stock markets. And right now in 2022, this seems to be accurate. The Fed has steadily been raising rates so far this year, and the only direction that stocks seem to know is down. So it seems this narrative is confirmed. Rising interest rates do hurt stocks, and that's really all there is to it. Thanks for watching this video, and we look forward to seeing you in the next video. Alright, so maybe there's just a little bit more to the story. Let's first start with some basics and talk through why it's generally thought that rising interest rates are bad for financial markets. In the world of financial investing, there is a focus placed on how you value a company. If you can value a company correctly, you can make better investment decisions on when to buy and sell said company. For instance, if the stock price of a company rises significantly above its intrinsic value, or it falls significantly below its intrinsic value, this can help inform investors on when to buy and when to sell said company, and should translate to better investment returns over a long period of time. Simplistically, this is the industry standard for how you value a company. It's called a discounted cash flow model, and in mathematical terms, this seems really complex, doesn't it? Well, it's actually not at all if we just break this down with a simple example. So let's take a large company like Apple. Now, we know how much Apple profits today because we can look at its quarterly reports. But Apple, like most companies, is spending money on things like research and development, like marketing, which should increase the value of the company down the road. It should increase cash flows and profits. So as with Apple, as well as most companies, we expect that company to increase in value over time. But how do we value that future value today? Well, you use something called a discount rate. For example, if I posed a question to you and I offered to give you $1,000 today, or I offered to give you $1,000 1 year from now, which would you choose? Well, you would obviously choose the $1,000 today because money today has a greater value than money down the road. The reason being is because theoretically we could take that $1,000, put it in a savings account and earn an interest rate and have more than $1,000 1 year from now. So I would either have to give you $1,000 today or more than $1,000 down the road for these to be equivalent scenarios. Well, the same idea applies to valuing companies. If we take all of the future profits that we might earn down the road, 5, 10, 20 years down the road, and we discount that for today, we gain something called a net present value. And it's that net present value that determines what a company is ultimately worth. Well, if we tie this then to interest rates, as interest rates rise, that discount rate rises as well, making the future cash flows worth less today than if interest rates were lower. Now, when it's said that the Federal Reserve is either raising or lowering interest rates, what's actually happening is they're raising or lowering something called the federal funds rate. Now, in layman's terms, the federal funds rate is essentially the rate that determines what banks as well as consumers can borrow and save at. In the modern economy, the job of the Federal Reserve is to raise and lower this Fed funds rate in order to stabilize the economy. During a booming economy, when unemployment is low and the supply of money is high, the Federal Reserve will raise interest rates in order to cool off the economy. If they didn't do this, generally you would see higher inflation on an ongoing basis, as well as larger corrections in the stock market. Now, the opposite is also true. When the economy is struggling and when we're in a recession, the Federal Reserve will oftentimes lower interest rates in order to spur on economic growth. This leads to cheaper lending, which leads to cheaper investing, which oftentimes leads to a rebound out of a recession much more quickly. Right now, the Federal Reserve is raising interest rates because a lot of things in the economy look very good right now. The job market is quite high right now. We're seeing more job openings than we are seeing applicants able to fill those jobs. Unemployment has fallen down to 3.6%. This is right around the level we were at before the pandemic. Both GDP as well as wages have been growing steadily. So generally, when the Federal Reserve raises interest rates, it's because the economy is doing well. And we know the economy doing well is obviously good for the stock market. And so we have these competing ideas in theory here between whether rising interest rates are good or whether rising interest rates are bad. So let's leave behind the theory and look at the actual data. So here's a chart of the federal funds rate going back to the 1950s. We've identified 13 regimes where we've seen strong rising interest rate environments, not counting the current regime that we are in. Now, if interest rates rising were bad for stocks, we would expect the stock market performance during these 13 periods to be very poor. But we actually see the exact opposite. During these 13 periods, we actually see that stock market performance is quite strong. The average growth in the S&P 500 during these regimes was 18.5%. Now note this is just price return. So if we add in dividends and find a total return number, this number would actually be quite a bit higher. Now clearly we're bucking this trend in 2022, right? Well, understand that the stock market responds differently in various interest rate rising environments. For instance, in the early 60s and late 70s, the stock market responded very negatively at first to rising interest rates, only to rebound and respectively grow by 20% and 26%. So rising interest rates can lead to some short-term volatility, but overall, stocks generally do well. Now let me be clear. I'm not saying that rising interest rates are good for stocks. I'm saying that historically speaking, they haven't been terrible for stocks. Even when we look on a more granular level, very similar dynamics play out. So it's generally thought, once again, that growth stocks do much worse in a rising interest rate environment than value stocks do. Going back to that discounted cash flow model, with growth stocks, you're generally betting on growth happening down the road. That company might not be making that much right now, but is a high growth company in future cash flows. And so once again, rising interest rates should affect that discount rate, thus lowering the value of growth stocks. If we split up growth and value separately and use an abbreviated history because of data availability, we see that the same dynamics play out. Now, yes, value does outperform by a slight margin, but it's not significant. In fact, both of these sub-asset classes performed over 20% during these rising interest rate periods. And from a more math-heavy perspective, there is a positive correlation between higher interest rates and higher valuations. And so basically what this means is the higher that we see interest rates, we tend to see higher valuations, all things considered. So from a discounted cash flow standpoint, the evidence seems to buck some of the theory here. In fact, stocks do worse on average in falling interest rate environments. Now, this really isn't surprising if we think about it. The Federal Reserve is going to lower interest rates during a recession in order to spur on economic growth. Well, recessions typically lead to lower stock market performance as well. But this is a classic example why you shouldn't hang on every word of the financial media. Their job is to attract eyeballs, to attract attention, not to educate. They try to distill down big, complex issues like financial market performance into simple reasons. The stock market is rising because of X, the stock market is falling because of Y. And the human brain likes simple and digestible explanations, but know that this isn't evidence-based. Now, this doesn't mean that interest rates won't tell you anything about financial markets. Quite the contrary. Interest rates can be a good indicator of things to come. But it's not about interest rates rising or falling, it's about the relationship between various interest rates. For instance, here's what a normal interest rate or yield curve looks like. As we see, the longer duration bond that we use, the higher interest rate we should earn. But at times this yield curve can become what's called inverted, which means that we earn less on a longer duration bond than we do on a short-term bond. Now, how does this make sense? In theory, it's because investors expect market volatility or a recession in the intermediate term. Thus, interest rates will lower in that intermediate term because the Fed will lower interest rates because of said recession. Historically, this has been a far more accurate indicator than simply interest rates rising or falling. In fact, yield curves inverting have predicted every recession over the last 70 years. To learn more about this yield curve indicator, click on this video right here. Although this is an accurate indicator historically, there's some important context that you need to understand. As we've showed in this video, things aren't always what they seem. Always remember, you don't need more money, you need a better plan. Thanks for watching.